Welcome, folks. Today, I wanted to cover the option basics so that a lot of people some of the folks in this group are not very well aware of the options. But it's like, for those of you who know it, it will be like a refresher. We are not going to cover in detail, but we are going to cover some of the important concepts so that it can be refreshed. For those of you who haven't encountered it, please feel free to ask questions so that it could be for the benefit of the people. No question is like something small or big, don't feel that way. Feel free to interrupt and ask, okay? And one thing I wanted to tell you, when I'm sharing the screen, the Zoom chat may not be visible. So just raise your voice. That's all I would suggest, okay? So let's move on. First of all, what is an option? Option is nothing but in the trading world, it's an exchange tradable derivative product. When I say this exchange tradable derivative, when we think of derivatives, most of you here in this call might be owning homes, and you would have heard about mortgage-backed derivatives, something like that, right? So what is a derivative? A derivative is something that is dependent on some other thing. For example, an option price is dependent upon the underlying stock price. So it's called a derivative. It's not, that means its primary source is like something else. So that's why it's called a derivative. So exchange tradable derivative product. Its price is based on the underlying product. So what is this product? It could be stocks, currencies, ETFs, commodities, or even bonds. So how do these options work? What is the general definition? It's a standardized contract between a buyer and a seller. So the person who buys a call, like you might have heard about calls and puts, which we'll talk in a bit later. But basically, this is a standardized contract. What do we mean by this standardized contract? Let's see in the next slide. So usually an option represents 100 shares of its underlying stock. That means when you say, hey, I am buying one option, that means you are buying 100 shares of this underlying stock. For example, Apple, you're buying one option of Apple. That means you have the right to buy 100 shares of Apple before that expiration. So we'll talk about that. What is an expiration? Option is nothing but it's just like a stock with its expiration on it. So usually the expiration cycle is set to the third Friday of the month. This was like before the weekly options came into play. Starting 2005, we have been having weekly options on many of the equities available on every Friday. In addition to these weekly options, we also have something called as minis. These minis are not still popular, but those have been brought out for people who have less capital. For example, minis represent 1/10 of a option. That means it represents 10 shares of the stock. Did somebody have something? Okay. So minis are 1/10 of the regular contract. That means it will have 10 shares. So what I mean by that, the price will be less, the movement will be less, and of course the profit also will be very less, right? That's what it is. But we are not going to cover minis in this section, but it is not still very widely available and used, but it is there and supported by some of the platforms. And if you look at how to identify, it ends up with a number 7 at the end. But let's not discuss about it today. Then we also call something called as a strike price. So now, don't worry if you don't understand the strike price. I will show you exactly what is meant by a strike price, which we are going to do later. But just try to grasp me. Strike prices are preset. What do I mean by that is all the prices at which you can buy an option are preset. For example, you cannot say, for example, you have a stock which is greater than $100. Usually the increments will be in terms of $5. That means they will have a strike price at $100, then they will have a strike price at $105, then $95 up to 0, and then whatever to the infinite on the other side, 105, 110. So you cannot have a strike price like 99 or like 101, 102, like that. So it's all preset. Now you might be wondering who sets this standardization, right? This is done by somebody called OCC. It's called as an option clearing committee. Think about it like a broker, okay? In fact, if you have been trading options for a while, you don't even know who, like every time you buy a call, buy an option, there should be somebody who's selling that option, right? In real world, we go and do this, like, you know, if you're buying from someone, you see that person, you then do an agreement and then get that, right? But here, you won't even see the seller because it's all digitalized and it's all standardized. That means the way the contracts are structured, the way the contracts will change if there is any event like merger event, split event, stock splits, all those things are taken care by the OCC. You don't have to worry about it, how things will look and all those things. At any point of time, your capital will remain the same, whatever you do, and whatever the underlying stock will be 100 shares or whatever, right? That will be there. So this OCC is also insured by FDIC, just like how your bank accounts are insured by FDIC. These OCC is insured by FDIC. That means your options and your money that you have put in the options are pretty much insured. Okay. Now let's move on to the next slide. Predominantly, let's talk about the option types, right? These are the different things. Predominantly, there are only two types of options, guys. One is called the calls and the other is called the puts. The calls actually means it's bullish. That means if you're betting the price of the underlying stock is going to increase, you bet on it through buying a call that will tell that the stock price will increase. What does a call mean? Try to grasp this statement once. It gives you the right to buy a stock, underlying stock, at the strike price prior to expiration. For example, let's say you have an Apple, and you are having 100 strike price, right? Let's say you bought that. Let's show me an example with the real things. Hold on. Let's take this Apple. Are you able to see my screen, guys? Guys?
Somebody? Yes, we can.
Yeah, okay, cool. So let's say we are right now, the stock price is at around 116.50. Let's say if I take this 100 and so these are called the strikes, guys. Remember I was telling you, all these are called as the strikes. You will have different strike prices, 111, 112. This is like this. And then it is all like, this is all fixed, 113, 115 and all those things. Usually, so this is how it will be, but the next weeks and all will be different. So it's like $1 strike price is also sort of there. So this is all preset by the OCC. Now, what I'm saying is, if you buy at 100, let's say you buy at 115, at the expiration, let's say you have the right to buy back the stock at that expiration. Let's say you can say you have either two options. You can sell your right to buy the stock at expiration to some other party, or you can exercise that right to get the stocks. Okay, it will be more clear later, but just wanted you to understand that sentence. Just try to grasp that. So it is basically the right to buy at the strike price prior to expiration. And then the puts. Puts is like, sorry, this is wrong. Puts means bearish. It gives you the right to sell at the strike price prior to expiration. Now, you might be wondering why they name these calls and puts. So remember I was saying, when you're buying a call, you're actually, when you're buying a call, that means somebody on the other side is selling those calls to you. At the expiration, what you're taking is, you're taking away why we call it a call, because you're taking the calls means you're taking the shares away from the seller. That means you take the right to buy at the end of the expiration. That's why you're taking the shares away from the seller. That's why we call it call. Puts means it's the other way. You're saying, hey, I give the right to short. That means I have the right to give you back the shares to the seller back. So the seller, basically as a buyer of the call or the put, you have the right to buy. That doesn't mean that you have to always exercise. You just have the right to buy and you have no obligation at all. Okay, just wanted to bring that point again. So let's move on to the next slide. Option buyers, right? These guys, option buyers, they own the long position. Now, I said this long position can be bullish or bearish. Basically, if you're on a call, you're bullish. If you're bearish, if you're on a put, you're bearish. As I said, buying a call is right to buy a stock at a specified price, but not obligation. And also, you have early exercise rights. That means you can sell it to the third party, and you can do all those things. Similarly, buying a put. Now, one thing you might want to see is option buyers do not get dividends or voting rights. For example, if you own a stock, you would get a dividend. But option buyers, though they are long in the stock, though the calls represent a long position in the underlying stock, you don't get any dividends or voting rights. Then when you're doing this long ownership, it always results in a debit. That means you have to take money out of your account to buy this. Now, you might be wondering a couple of things, right? Hey, what is the disadvantage? Why would I want to do options, right? Why is it like, why people talk about options? I don't get any dividends. I don't get any voting rights. So why is it so good, right? Now think about it like this. If you want to buy, let's go back to our trading platform. If I have to buy, let's say today the Apple is at 116.50, and if you have to buy the 116.50 calls, 160, the 100 shares of Apple at 116.50, you have to shell out around $11,650. That means that is 116.50 into 100 shares. But think about an option, right? This option is 115 is at like $2.86. That means we'll do the math. There's something coming up called option prices, but I just wonder you'll be shelling around 28.60 for this week. So you are spending less and less. Forget even this. Let's go deep in the long-term options. Let's say you're taking Jan 21. Which is like next year, or even take 1 year from now, which is September 21st. If I go for September 21st, what will happen? The 115 call is only 1985. So still you will be spending only you'll be spending only like, if you buy one option, you'll be spending only $1,970. So which is much cheaper than you buying the stock. Now you might be saying, hey, there should be now, that is great. Now you don't get dividends or voting right. What is the other advantage? Number one, you can buy it for cheap and you can keep the rest of the amount in cash, for which you can get interest from your broker. Maybe that interest could be as equivalent to that or not, but definitely guys, options should definitely become part of your portfolio management. It is one of the risk management tools that you can use to reduce the amount of money that you use for buying your positions. Okay, that's what I wanted to say about it. So that's what it is all about. So let's talk about, sorry, did I move? Yeah, option cost. Typically, you will say something like that. You will see something like this. Buy 5 Apple October 16, 110 calls for $3. Here, what does it mean? Option represents 100 shares of the stock. Price $3 represents the price for a share of the stock. That means you're not telling for 100 shares, but you're saying for one share of the stock, it is $3. So the total price of the one option is 3 into 100, that is 300. You want to buy 5 options, so your total cost will be 1,500. I'm sorry. Whereas if you want to buy the same 100 shares of the stock at 112.58, it will cost you 112.580. Think about it, guys. Apple, you have this option, and you are betting on the earnings, and the Apple gave a very bad earnings and it nosedived. All you would be losing is only this $1,500. Whereas this money you would have done, if let's say if Apple goes to 60 or 50, you would have lost half of it, which is $6,000, which is 4 times the value of it. So definitely that's why options, you need to leverage the prices. So just wanted to think of an option like a coupon, guys. We all go to get our oil change, right? So we get a coupon. How does the coupon say? Hey, you can get your oil change, synthetic oil change for $29.99 if it is expiring by this date. So what I'm saying is the original price might be $59.99 and they say $29.99. So the $29.99 is your option strike price and you are getting the right to buy at that price for whatever, right? That what you get to buy 100 shares of the stock for 110. Here, this 110 is called the strike price or the exercise price, guys. When you get, for example, you keep your options until the end of the expiration, what happens, and let's say your stock price is at $112.58, then your option, then you will get your stock assigned to stocks to you. So that means your price, buying price would have been 110, but you would get the stocks at 100. So you got a discount. So 112 minus 2, you are already at the profit of $2.58 when the stock is assigned to you. So strike price is where the deal is struck. And as I said before, strike prices are standardized, okay? That's what it is. So let's move on to the move. This is pretty much very standard, guys. Long option prices, long call option prices increases as the price increases. And then the long put option increases as the price decreases. One big advantage of puts is I know we can even short stocks, but that leads to margins. But if you think about puts, there is no naked puts, there is no margins at all. For example, let's say you have a portfolio of $100,000 with Apple, Google, Amazon, everything, right? Now, let's say the market was tanking and how do you hedge that? You can hedge it by buying some SPY puts or even Dojo DJX puts or something, and you can do a puts so that that becomes your insurance, so that you can even capture your downward market. So that is what I mentioned this as an insurance. So it will help you to hedge your losses. So then again, this price of an option, right? It depends upon three factors. One is the underlying stock movement. Number two is the time. And the number three is the volatility. So you might be saying, hey, my option is increasing, my stock price is increasing, but still my option prices are going down. It depends on what option have you bought. For example, let's say today, let's say you have, today we had one trade, which is DKNG. And if you had bought, we bought a 60 puts and we are right now at the money call, at the money puts. Let's say if you had bought up about 55 puts and what happens, you are out of the money. When you are out of the money and as you're getting close to your expiration, your volatility and the time, your time decay gets into play and your option value keeps decreasing. So you might be losing money, though it is moving closer to the 55 and below, you might be losing it. So I just gave that as an example, but I just wanted to bring that up. Okay, then terminology at expiration. Okay, now let's look at this, guys. I wanted to show you this, how it looks. One second. Let's say we want to buy this 115 call with this, wait, we went to January. Hey guys, any questions, guys? I don't feel like I'm talking to myself. Okay, no questions, okay. Okay, let's say we are buying this 115 calls. I click on this ask, so it will show me Apple 116. Let's take only one, right? I'll just put a one option and the limit and all those things. So it shows me 2.81. By the way, I use E-Trade, guys. Whatever your platform, they will have something called as snapshot analysis. Okay, this will give you an idea how much you will make on a trade or how much you will do on a trade, okay? So let's look at this snapshot analysis. And then for further clearer, let me put it in Analyze in Trade Labs. Now what happens here? You see here, when I buy a October 9 215 call for 281 limit, The maximum profit is, probability for maximum profit is infinite. Why? If the price increases above 115 and it stays and stays above it, and then if it goes to 130 or 140, all that profit is there for me to take. But what is the max loss? The max loss is only $281. That is the amount that I paid for the call. Okay. Now let's look at the break even. The break even is 117.81. How is that? Because you are looking at a 115 strike price, and you are paying $2.81 for that call. So we are having 115 plus $2.81 is 117.81. By the way, guys, all this break even, max loss, and profits are only at expiration. Because if it is not at expiration, there is other factors like time extrinsic value, which we'll talk a little bit later. The time decay and volatility will be there, so which becomes zero at expiration. So we are talking only about intrinsic value. Okay. Now we'll talk a little bit later about the intrinsic and extrinsic value. But what I'm trying to tell you is the break even you should always consider at expiration. It will be 117. If you look at this graph, if the price is at 110 to 114 or even 115, you're losing money. If it is greater than 115, still you're losing money. But at 117.81, you get profit and it can go up. So this is how it looks, guys. Okay. So this is how the profit will go up for a call. So the max loss you can have is at most is $281, which you put for the call. Okay? That's the beauty about the option. You can never lose more than what you put. Okay. All right, let's go to the next one. So that's what I was trying to tell you there. Now let's talk about short options, right? So far we talked about long side. Now when you are buying a call, there should be somebody who is selling your call, right? Now, what do these guys have? They are called as option sellers. These guys, they sell the options. So these guys have obligations while the buyer has the rights. What do I mean by obligation? Let's say if the buyer exercises his rights, the seller has an obligation to give him the shares. He cannot say, hey, I will keep my shares. The reason why he has an obligation, because seller receives the credit. Whenever you are on the short side, you receive a credit upfront. Let's talk about what does it mean in the real world. Let's go back to this thing and let's look at again the options, right? Remember, I was telling you 115 calls, when you're buying, when you're long, what you're telling is, you're telling that, hey, I'm betting that this stock is going to go up. But when you're short, you're telling me that, hey, I am betting that this stock will not exceed 215. If it exceeds 215, then I will be losing. In fact, we'll also look at the charts, how it looks, okay? Now on the ask, I'm getting a long option, but on the bid, I will get the short option. Now you might be asking me, why this bid and ask? The difference between the bid and ask is how the market makers make the money. That's a different topic, but let's not get there. But let's click on this $2.76 on a 150. So what happens? Okay, look at this. You're telling, let's take one option, so for the convenience. So you're telling me, sell 1 October, limit day to open. So you're telling me I'm selling a call for 115. Wait a minute, is this selling? Yeah, it is selling, right? So you're saying that I am selling this call, and then you're saying limit to 81, 270 to 86. This is how it is, right? Now let's look at the same thing in the trade lab again. How does it look? You see this? You see this? If you see here, if the price is 110, you are still profitable. Whatever credit you got, the $2.76 remains with you, 276. So what is the max profit? Again, it's 281. Max loss is again this one. I don't know, this is not showing up correctly, but the graph is like this one. So the risk profile is either 110, 114, you're like, okay, you're still making money. But the moment it went, you see that the moment it crosses this 115 and you paid that 117.81, this is where you're starting to lose money. Now you can lose infinite amount of money as the stock goes up. So you have to understand the seller might lose a lot of money if the stock goes uh, against him, against his bet that the stock will remain low. So this is the selling thing. This is one thing I wanted to say that. Okay, so that is what. Now there are two ways you can short an option, right? Again, in short also there is a short calls and there's a short puts. Short calls are the bets that you are betting that the option, it's opposite to the long call. You are betting that the stock will remain low. Whereas the short put is an opposite of long put. You are betting that the stock will remain above a certain price. Okay. Yeah, we have graphs which I will show you later. But what you have to understand is there are two ways you can play all these things. One is the naked shorts and the other is the spread. When I say naked short, what I mean is you can just sell a call. For example, a lot of people do covered calls, like, they do that. But I would not recommend that because number one, it requires a lot of margin and it's going to eat into your margins from the account. But that is one way of doing it. And the second way is the spreads, where you have an inherent hedge against your shorts. So that way, and also your margins are very, very less. And all you need is how much the difference in the strike price minus how much you spend. Okay. So as I showed you in the graph, risk is unlimited beyond the break-even points. Rewards is limited rewards. That means you can only make $281. You cannot make, in the example that I showed, you cannot make anything more than $281. So but the option sellers can get out of trades at any point of time by buying back the contracts. If they feel the stock is going against their bet, they can always buy back and get out of the trade. Any questions, guys, so far? Guys? Okay.
None, Srini.
Okay, so far everything clear?
Yes, thank you.
Okay, so short options, this is about the short options, guys. Now let's go to, so as I mentioned, option seller can, by buying back the contract, I never recommend naked shorts, need an inherent hedge using spreads. Spreads is a different topic. We'll talk about it in another training because it's by itself, it's huge. We have some blog posts which you can look at it for vertical spreads, which is the most common type. But we are going to do a lot of training on these options in the coming weeks. Okay. So, but right now, just understand that spreads is a preferred way of selling. Okay. So now let's go to the next slide. Okay, this is the long call, guys. Let's say you are long on a call. You say you have a buy one ABC, May $50 call for $5, right? Now what happens? If that means your strike price is 50, guys. That means you're betting that your price will stay around 50, more than 50. For you to make a profit, your price should be greater than 50 plus 5, which is $55. But if you look at this graph, if it is 35, you only lose $5. Even if it is 55, you lose whatever you put. But beyond that, you're in a profitable zone, right? Let's take the next example, the short call. When you're shorting, we already saw this. This is the $5, it goes down, and then it keeps going down and down. There's an unlimited risk here, but a limited reward here, okay? Now, similarly for a short put, when you're shorting the put, I remember I was saying you're betting that the stock is going to go up than the price that we bought in, but the strike price. So $50 put, so that means you put $5 for it. So that means you've already collected the premium of $5. So if the stock price is a 15, it goes to minus 15, you're losing money. You lose your $5. You lose only your, you have unlimited risk. But the moment it goes above 50, you're safe. You make always the $5, but the reward is limited. You have only $5, right? That's what it is saying. The next is I wanted to talk about a little bit of options terminology. Guys, just wanted to bring this up. All options, all stocks do not have options. What I mean by that is there are some stocks that still do not have options, especially the stocks that are below $5, and they may not have even options, right? For example, I think I know one stock. Hold on a minute, if I'm right. Oh, this has, see, this doesn't have any, this is Just Energy Group. It's a it was at 28 cents and it made a big move to $7.44 in recent times. And now it is at $5.17. They don't have options. So if they are coming from the penny stocks and then they move, they may be listed, but they don't have options. There are a lot of stocks like this that don't have options, okay? So you have to be, you must be hearing the terms optionable. That means that stock has an options, okay? That's what it is. Then, as I mentioned before, calls mean generally bullish. When you're saying, hey, you're bullish, that means they're buying calls, puts for the bearish. This is a very, very important thing, guys. American versus a European, right? What it means is American okay, let me show you an example. If you go to, right, CBOE.com is a big option stock exchange. Okay, if you go here and you click on products and you click on single stock options, right? And let's see what happens here. Let's create the equity option specs. You see, this is all you'll see every time. Symbol, remember I was saying it's a standardized way. They do it this way. They have all the symbols, strike price intervals, strike prices, expiration, positions and exercise limits, margins. They should be somewhere, exercise style. Exercise style is called American. What do you mean by American? American means you can exercise, that means that you can exercise your options before expiration. All equity stock options are American style, whereas some of the ETFs are like European style. What is European style? European style is nothing but you cannot exercise your options before expiration. So that is so because of that, the American style options are expensive because you get more accessibility to the options than the European style. What is one example for the European style? Let's look at it. You must have heard about volatility, right? Volatility and let me show you that. CBOT volatility index options. If you look at VIX, I'm trying to get you this. 1 second, guys. Where are they? Futures and option contracts, VIX options, weekly, somewhere it should be there, guys. Historical options, do they know? Not that. They changed something here. Okay. Trying to see that, but let's see options, CBOE, volatility index. Okay, let's see this exchange traded product options. Option exchange on US stock price index. Options on traded products, stock. Sorry guys, I'm taking longer than I'm not able to find this information, but VIX is European, and sorry, there is somewhere the information they've changed it the way they used to show that. But the European, what happens is they cannot trade before the expiration. That means you have to let it expire, and then you have to do that. That is what is the options at expiration. So that is what is that. So definitely they have somewhere here, but for the benefit of time, I'm just putting that. But there are some ETFs like OEX, which are traded on both European and American. What happens is the OEX is for the American, and XOE is for the European. So the OEX is definitely expensive than the XOE. They just reverse the symbols. Okay, that's what it is. Okay, so that's pretty much about what is the exercise style. Okay, so you have to remember that American style options are a little bit expensive. And when I say open versus closing, oh, sorry guys, open is like when you are opening a position, and closing is like you're closing the position. If you look at any of the four things, right? Let me show you this one more time. If you see here, and you go to this options, let's take something again, Apple. And if I click on this, okay. If I click on this, right, you will see there will be four options. So when you buy, there'll be, you're saying call, put, or something like that, right? So again, buy call, buy to open a call, buy to open a put, then there'll be sell to close on a call, sell to close a put, right? So whenever you're selling the option, you have to buy back. When you're buying option, you have to always close it with the sell to close. Okay, so that is what it is. So you have all these options in this things. Okay, now let's go back to the presentation. So option price, this is very, very important. Option prices is made up of two components. One is intrinsic value and one is extrinsic value. Let's look at this, right? Let us look at here. Let's take example of $115, right? Let's take this option, right? What is intrinsic value? Intrinsic value is the value that is related to the stock movement. If I take this 115 call, the call price is at $2.86. But what is the corresponding stock price? It is at 116.50. So if you're talking about 116.50, what is the intrinsic value? Intrinsic value is the difference of the price between the stock price and the strike price that you're considering. So 116.50 minus 115 is $1.50. So that means my intrinsic value is $1.50. You have to remember this is expiring on this week. So where does the additional $1.36 come from? The $1.36 is called as an extrinsic value, and it is the premium that you are paying for this option. The intrinsic value $1.50 is the immediate benefit. They call it as an immediate benefit. That means you can immediately recognize that benefit if you buy that. But you're paying an additional premium of $1.36 to own that option. Now, this extrinsic value, as it gets closer to the thing, remember I told you it consists of two things, volatility and time decay. So time, this time gets eroded as you get closer to the expiration. So let's say on an expiration day, let's say on October 9th, the price is still at 116.50. What do you think will happen to the option price? The option price will be at $1.50 on a Friday afternoon. The reason being is all the extrinsic value is eroded. That means you will only have intrinsic value. If the price is greater than the strike price that you considered, that is, we call it as in the money. If the strike price is equivalent to the stock price, that is at $115, the option value will be zero. If the option price is out of the money, let's say it is less than $115, your option price will be zero. There are only two ways that the option price can end, guys. It can be either worthless or it can have an intrinsic value. Okay, that's the only way it can get closed at an expiration. Just wanted to bring that up. Okay, okay, let's go back. In the money, at the money, out of the money. That's what I meant. I mentioned all these three things, right? In the money, at the money, out of the money. So now let's talk about volatility, guys. Volatility is like is the something that, like, you see when the volatility is usually measured by VIX. The VIX, as the VIX increases, so does the extrinsic value of your option. When the volatility increases, all the calls and the put prices of the same strike price increases equally. What do I mean by that? Is only the extrinsic value is increasing because of the volatility, whereas the intrinsic value remains the same. Okay, so that's what we are saying. Now, different strike prices might have different volatility. How is this measured? There is an option geek called Vega, which we'll do on one of our trainings with all the option geeks like delta, gamma, theta, vega. There are 4 option geeks that we need to consider. But for right now, understand that Vega measures the option price susceptibility to the volatility. Okay, that's all it is. So remember, as the volatility increases, prices of all options increases. As the volatility decreases, prices of all options decreases. So the golden rule is buy low, sell high. So you need to buy when the volatility is low, and when the volatility is high, you need to take advantage of it and get out of the option. That's what it is. Okay, that's it. The next one is the time decay. Time decay, as I mentioned before, the extrinsic value erodes with the passage of time. At expiration, extrinsic values are 0. So intrinsic value will never be affected by the passage of time. Now, this extrinsic value is not linear. Oh, every day it will go little by little, decrease by decrease. No, that's not how it works. So I'm sorry, I have a different. For long-term calls, forget about the next 3 points, guys. It's a repeat. For long-term calls, let's say you have like a leap calls, right? The time decay happens the most in the last 30 days of expiration. But nowadays we have a lot of weekly calls and which are like very common. So when does the time decay happen? The time decay happens the weekend prior and on a Thursday evening. Those are the 2 time periods when you have a huge time decay. Okay. So that we got to remember this. This time decay plays a significant role in the price of your option, because if you're playing so much, that is the reason why you need to be very, very deep in the money so that you can get most of your intrinsic value when the price goes up, because you cannot rely on extrinsic value and volatility, right? It could erode as you get closer and closer to the expiration.
Yes, Srini, quick question, Srini. I kind of missed out on what you said. You said the volatility changes on 2 different times. So you mentioned like a Thursday. What are the 2 factors on which you mentioned the Greek, but other than the Greek, you mentioned 2 factors that have an impact on the time decay, right? What are those?
Oh, no. Oh, okay. No. What I mentioned was the time decay is not linear. Is this? I'm sorry, who is this? Who asked the question? Sorry.
This is Senthil.
Huh? Senthil. Hi, Senthil. So I didn't mention 2 factors. What I was telling was the time decay is not linear. What I was mentioning was, if you have a long-term call, always before we had weekly calls, we used to have only monthly calls, right? So what I'm saying is the time decay happens the most at the 30 days prior to expiration. So that means it will start decaying from that point of time. Let's say you are 2 months away from your expiration. You may not see any time decay in that 60 day, from 60th day to 31st day. 31st day. So, but as you get closer to the 30th day, you will see time decay happening, right? Okay, you will see week after week and all those kind of things. But in the case of weekly calls, it is like every week there is an expiration, right? So if you're buying next week call, you will see significant, some kind of time decay happening on the weekend prior to that expiration. For example, if you're buying October 9th call on October 2nd, last week, you would have seen some time decay. And also on the Thursday, right? What happens is on the weekly calls, every Thursday, a new set of the calls for the next week comes up. The fresh set of calls come in. So what happens is, and the calls that are for this week will get time decay. So that is what happens on a Thursday evening. So Thursday morning, you will be able to trade the next week calls. And that way, what happens is the time decay is the max. I was not telling two factors, but I was just mentioning this is when the time decay happens the most. Did I answer your question, Sundar?
Yes, that helped, because I initially missed the 30-day thing that you mentioned, and I
Yeah,
heard the Thursday, but I wasn't sure what you meant by the Thursday. Thanks for the clarification.
Yeah, no worries. Yeah. So this is what it is, right? Now I wanted to mention this, guys. Sometimes we get busy with work. This has happened to me so many times. Like say, this is, let's say you think that the option is expired. Let's say you have an option. Let's take this example again, 115 calls, right? Let's say October 9th, you did this, and then you thought the price was like around 114 or something like that on a Thursday, and you said, oh, this is going to expire and I won't be making any money on it. I'm just telling you that. But for some reason, some news comes on a Friday morning or a Friday afternoon, and what happens is that the stock rises and it finishes at 115.01. I'm just giving a hypothetical example, or even $115.10. What happens is, even if it is 1 cent more than your option or your strike price, that will be exercised. That means what it will do is it will check if you have the money required to buy. Let's say you have one option. Like it will require to buy the 100 shares of Apple at 115, and it will assign it to you. That means next day, next evening, next Monday morning, you come in and see you'll be having 100 shares of Apple sitting in your account for $115. So it's not a bad thing, but again, if the price went to $117 or $118 on the expiration, you got it at 115, you only spent $11,500, but the price is currently at 120, so you can sell it outright for $5 profit. But it's a profit on the stock, not on the option, right? Which is not much, but still it's better than something. Then the other thing what I wanted to tell is, the second thing is, even out of the money, remember I was telling it's around 14, some big news breaks out. So you have to be careful if you don't want it to get exercised or all things. Now, I wanted to say exercising is like you buy back the share, and then sometimes you, let's say the option price is doubled. Let's say you bought a 115 call at for $3, $286, and some Apple stock went up, it went to $20, and you want to sell away your options to a third party. That means you're selling the right to buy the option, right to buy the stock to some other party. This is what usually happens, especially when you're doing debit. We recommend you to do this, to sell the right to buy to someone else, because that is how you make maximum profits on options. Okay, so that is one thing. This is called automatic exercise. If you don't do anything about it, you will do that. Usually, when you are long on a call, long on an option, we recommend you to sell the right to third party. If you are short on an option, you can keep it. Let's say you can keep it till the last minute to get the maximum profit. Anyway, you would have got the credit, and you can just let it expire. Okay. Anyway, the time decay comes into picture, and it's good for short sellers. Okay. That's it.
So, okay. Srini, Raghu, a quick question. So, are you saying sell to close is different than deferring to sell?
Come again? I'm sorry.
So, the sell to close on an option is different than, you said deferring in the previous slide. I think you had something said deferring to sell it to somebody.
Right? So, no. This is selling. Oh, okay. Let me tell you this, right? Let's say the same example, right? I took this 115 call, right? Now I bought it for $2.86, right? I buy this call, I bought it for $2.86. Now you are watching that, you bought it on today, let's say. Now Apple went to $120 and your option prices are at, let's say, $5.
Yeah.
Now you can go and close that option, right? That's what I meant by selling. Sell to close.
Yes.
Yeah, sell to close, and you can. What happens is you're transferring the right of you're transferring your right to buy the stock at your strike price to someone else by selling it.
Okay, so that's what you mean. Sell to close is same as transferring your right.
Sorry, that's what I meant. Yeah, that's okay. Yeah. I just wanted to explain that to make clear. Okay. So let's go to the next one. Just wanted to talk about this market mechanics again. Stock goes up, calls increase, guys. Preferred in the money unless you expect explosive movement. Let's say you have like a biotech stock like Marna or something, which is coming up with the results like FDA approvals or something like that. Then unless you have a big explosive movement which will take the stock price above the strike price, out of the money strike price that you bought and way above, so that you can make, so that it becomes deep in the money calls. Unless you have that kind of a scenario, I would highly recommend to buy preferred in the money. The reason being is deltas are always higher. A delta is nothing but how much an option price moves. Again, we'll do this more details in Option Geeks, but just wanted to introduce to you. Delta is the amount an option can move for every dollar move in a stock. And as it becomes deep in the money, there is another option geek called gamma, where the amount of delta change. That means, let's say you're at 100, let's look at this example, guys, just for your example. If you have 115, this is in the money, and look at this delta. Delta is 0.625, and this means this is 0.07 is gamma. So let's say tomorrow, this is for 116.50. Let's say it goes to 117.50, then your delta will keep increasing. It will become 0.69 because 0.625 plus, then this is the variation of delta for every dollar move. So it will become 0.69. That means your options are moving faster now. So deep in the money calls will get you more value for your buck as it becomes deeper and deeper. Does that make sense what I'm talking about? Anybody, can you please respond yes? Hello? Did I lose you?
It does, Srini.
Oh, okay. Cool. So that is what it is. So deep in the money calls, so that's what, but again, there are always scenarios where there will be also exclusive cases and all. Stock goes down, puts increase preferred in the money. This is the typical scenario where we are right now in the market. Its stock goes sideways, always it goes down as the extrinsic value erodes with time. As the stock goes down and up and down, we are seeing with the Tesla calls, we are seeing with everyone because it's like moving sideways. It's moving up and down between a range. Unless it breaks out, the intrinsic value cannot increase and extrinsic value keeps eroding. Okay, just wanted to bring that. So some of the pricing principles, guys, this is just for one thing. I don't know what is the time. Oh, we are already 6:30, 1 hour. So let's finish this. So deep in the money calls are always worth more, guys. What I mean by that is, as I mentioned, lower strike calls are worth more than the higher strike calls. So on the same side with the puts, higher strike puts are worth more than the lower strike puts. Then also, longer dated options are worth more than the shorter dated options. Why? Because if you have a longer dated option, there is a very high possibility of the options moving in the right direction. So that means you will have more buck for your value, so that it will be pricier and all those things. And also, as we already saw, as volatility increases, price increases. And as I mentioned before, options at expiration are either worthless or will have an intrinsic value, right? And finally, this is a very important, guys. Difference between two call prices or put prices cannot be greater than the difference in strikes. Let's look at that. Difference between call prices and put prices. Let's say you have this 115 and you have this 120. 115 is what, 286? Oh, I'm sorry. And 120 is like 64. So how much is it? $2.86 minus 64 is $2.22, whereas the difference is $5. So this is the concept of spreads, guys. So definitely this will never be greater than the difference between the two strike prices. Okay. So that is what you have to understand. Okay. So that's pretty much it, guys. I wanted to talk about it since we are running over the time. We'll stop here. Any questions?